Hello, I'm Angie Austin with Oil and Gas 360 here at the 2015 Oil and Gas Conference in Denver, the 20th year of the conference. Katherine Spector is joining us. She is the head of Commodities Strategy with CIBC World Markets. Hello, Katherine.
Hi, Angie.
So have you been to the conference before?
This is my second year. So I'm a relative newbie.
And it's a pretty big conference. People seem to be pretty upbeat and getting a lot out of it, a lot of meetings.
It is. I think this is the kind of market where people have a lot of questions, so that may have contributed to the turnout as well.
I'm sure. All right, let's talk about the downturn, the commodities downturn. Do you think the factors behind today's commodities downturn are a page out of the past oil supply demand cycles, or is it something different this time?
Well, I think there's some similarities and some differences, actually. On the one hand, this is a cyclical market, and I'm sure as some of your previous guests have probably mentioned, if you've been in this business long enough, you've seen these cycles before, and this isn't necessarily anything new in that respect. There are a few differences, though. I would say that the biggest difference that's on everyone's mind, I think, is this boom that we've had in U.S. oil and gas production, which really is sort of unprecedented, both in terms of the type of production that's going on and the speed and magnitude. But there are also some other interesting sort of nuances here. A lot of people like to make the comparison of what's going on today to what we saw in the bear market of the early 80s. And I think there are actually some differences there. And one is OPEC's spare capacity. Back in the early 80s, it was a very weak market for a variety of reasons, and OPEC had a whole lot of spare capacity. Right now, OPEC is overproducing. They're putting more on the market than the market needs, but they don't have a whole lot in reserve. So in other words, if something were to go wrong, they don't have all that much to add. So that's sort of a difference. And I think it's really important when we have a big move like this to sort of get out of the very near term and put things in a bit of a historical context.
Interesting. All right. Let's get some of your expertise now on some predictions. The E&Ps are doing a great job of squeezing more oil out of each well. Some companies are reporting record production. When do you predict U.S. shale basin production will run out of steam without an infusion of new drilling?
Well, we do know that sort of in academic terms, the type of production that's going on in the U.S. is a very drilling-intensive type of production. It's a bit of a treadmill because these wells come online very quickly at their maximum life of well production, but then they decline very quickly. So what's interesting about that is that it means that production companies have a lot of opportunities to change their mind. They have to make that drilling decision over and over. That doesn't mean that things come to a screeching halt overnight. And one other thing that makes the U.S. industry unique, I think, is their nimbleness. They are very good at cost cutting. They're very good at finding efficiencies. And the tricky thing for analysts like myself is that we've never seen this type of production before. Yeah. So we can't go back to our old data and model exactly what's going to happen. This is really new. The EIA, the information arm of the Department of Energy, does a great report that they started maybe a year or two ago called their Drilling Productivity Report, where they do attempt to model what's coming next. And they have been showing some fairly meaningful month-over-month declines in U.S. oil production in major plays since about May through September. So we're waiting for the final data to see if those predictions are borne out in the actual data. And then we'll sort of start to get some data that we can work with to estimate how quickly this might turn.
Interesting. All right, Katherine. Oil prices are less than half of what they were last year. Shale drillers are scrambling, as you know, and OPEC keeps increasing its output. Some people have speculated that this is what a price war with the Saudis looks like. What do you think?
Well, I think that it's a catchy narrative, the whole shale versus shake narrative that was on the cover of The Economist. I think it is a little bit overdone, though. I think that the Saudis, like everyone else, know that although U.S. producers might cut back their production relatively quickly when prices fall, they're also going to increase their production very quickly when prices go back up. So this isn't necessarily a sustainable way to really turn the market. Now, I think the U.S. is probably part of this strategy, but I actually think the Saudi strategy is targeted just as much at other OPEC members. There's going to be a lot of intra-OPEC competition in the coming years as Iran ostensibly comes back to market, as Iraq continues to grow their production. And then there are some other producers in other parts of the world that maybe we're showing some growth that will have a harder time in a lower price environment, places like Russia, deep water projects in places like Brazil. So while I think this may be in part about the U.S., I think it would be an overstatement to say this is all about the U.S.
Interesting. Okay. All right, let's talk about Iran. Post-sanctions, Iran is on people's minds, as you know. So what's your view of Iran's production capacity? How much is it? Will it have a big effect on the market? And then threefold, what's the timeline for their oil to reach global markets? So just kind of the lowdown on Iran.
Yeah, it's a really important question because I think this is probably one of the more bearish variables sort of overhanging the market right now. If we sort of take a step back to before we had this round of sanctions and Iran's output was really curbed significantly, they were already sort of plateaued to slightly declining in their production. They weren't really growing. So I think we have to keep that in mind as we think about what a post-sanctions world might look like. Now, with the agreement that was put in place with the P5+1 in Iran, there is now a period of implementation and then inspection of that implementation. So this oil isn't going to come back tomorrow. It'll probably take, in our estimation, about 6 months or so for that process to transpire before we start to see meaningful sanctions relief. Now, it is pretty well flagged that Iran has some oil in inventory that they can probably deliver pretty quickly, and that might be an initial bump of supply to market. But then we have to think about what sort of production they can increase more sustainably. And we're looking for about 500,000 barrels a day or so in 2016. Could be a little more, could be a little less, depending on how quickly they ramp up, but probably something in that neighborhood. Beyond that, to really increase their production much more significantly, they're going to need to spend some money and bring in some service companies and things like that. And that's not a process that can actually start until the sanctions are relieved.
Okay. All right, so let's take a little look at the future here. A year from now at Intercom's Oil and Gas Conference 2016, how do you think the industry and the global oil markets will look then, a year from now, when we're sitting here together talking about it?
Well, in my view, prices will be higher than they are now. I think we may not be at the lows, but we're probably near the lows at these prices. And I think we'll gradually start to improve going forward. That doesn't necessarily mean we're going to bounce back up to the highs again immediately. I do think we're also in for a period of volatility in this market. The Saudis had done a really good job for many years of keeping the market very range bound, and now they've said they're not going to do that anymore. So that says to me that we're probably in for a lot of sort of peaks and troughs here over the next several years. The silver lining here, I think, is that this is an opportunity for some rationalization in the U.S. market, which is inherently a very strong sector in the U.S. We've already noted how it's an industry that's very good at finding efficiencies and optimizing and cost cutting, and this price environment will force them to do that, and we could end up with an industry that actually comes out of this in a much stronger position.
All right, so my last question would be, first of all, you're so good. How did you get into this?
Well, I've been doing it for a while. I've had a lot of practice.
Is this something you'd always wanted to do? How did you get into this,
sort of
arena?
A roundabout way. I decided that energy was for me in the late 90s when not a whole lot of other people wanted to do it, back when oil was at a much lower price level and it wasn't really attracting a lot of people. So a few years later when the commodities market took off, I guess I was just in the right place at the right time.
Well, your enthusiasm's really fun.
Well, thank you.
All right, I'm Angie Austin with Oil and Gas 360, and Katherine Spector, thank you, Head of Commodity Strategy with CIBC World Markets. Enjoyed the interview. Thanks, Katherine.
Thank you.